Every share you've ever bought on your phone, you didn't buy it from the company. You bought it from a stranger. That one fact changes how you should think about markets entirely. Most people picture the stock market as this single thing, one giant room where money flows. But there are actually two completely separate systems running underneath every trade. One is where companies raise real money directly from investors for the first time. The other is where investors just trade that same money back and forth among themselves. Here's the question nobody asks early enough. Does the company even benefit when you buy their stock today? The answer is almost always no, and that's not cynical, it's just the structure. A man named David bought shares in a well-known tech company in 2201 at $47 a share. He felt like he was investing in that company. He wasn't. Not really. That company hadn't seen a single dollar from a trade like his in years. So where does the company actually get the money? That's what the primary market is. When a company decides to go public, it doesn't just list on an exchange and hope for the best. It goes through a process called an IPO, initial public offering. And that word initial is doing a lot of work. Initial means first. One time, that's the only moment the company touches investor money directly. The company works with investment banks, sets a price per share, and sells a fixed number of shares to the public. Say a company offers 10 million shares at $20 each. That's $200 million going directly into the company's balance sheet. That's real capital. That funds hiring, production, expansion, debt repayment, whatever they need it for. After that one event, the company steps back. The shares now belong to whoever bought them. And that's where the secondary market begins. The secondary market is every transaction after the IPO. Every buy, every sell, every trade you've ever made. New York Stock Exchange, NASDAQ, the app on your phone, all secondary market infrastructure. None of that trading sends money to the company. It moves money between investors. A simple way to hold this. The primary market is the original sale. The secondary market is the resale economy. Think of it like a concert ticket. The artist gets paid when the venue sells the ticket. When you buy that same ticket from someone on a resale platform for twice the price, the artist gets nothing. Stock markets work almost identically. Most of what people call investing is just reselling. Now, here's where smart people get confused, and it's worth slowing down on this. Some argue, if my stock purchase doesn't help the company, why does any of it matter to them? It matters for two reasons, and both are indirect, but very real. First, a higher stock price makes it cheaper for the company to raise capital again in the future. Second, employees and founders often hold shares. Their personal wealth is directly tied to market price. So the secondary market still influences the company, just not through direct cash. That's the nuance. The mechanism is indirect. It's not nothing, but it's not what most people assume. Back to IPOs. They aren't open to everyone by default. That's one thing that surprises people. When a major company goes public, the initial shares are typically offered to institutional investors first. Pension funds, hedge funds, large asset managers. They get first access at the IPO price. By the time retail investors, regular people, can buy, the price has often already moved significantly. A company priced its IPO at $18. By the time markets opened that morning, shares were trading at $31. The institutions who got in at $18 were already sitting on a 72% gain before most people even woke up. That's not illegal. That's just how the allocation system has historically worked. So when you hear, "I'm buying this IPO," in most cases, you're buying it on the secondary market, not the primary. You're buying from whoever got the IPO allocation and decided to sell. Different risk profile entirely. The price behavior of IPOs in the secondary market is also genuinely strange. Some IPOs pop 40%, 60%, 80% on day one. Others fall immediately and don't recover for years. The pop often signals that the IPO is underpriced. The company left money on the table. The drop often signals the opposite. Investors paid more than the business was actually worth at that moment. Neither outcome tells you much about the company's long-term fundamentals. It tells you about supply, demand, and the mood of institutional money on a specific morning. A guy refreshed his brokerage app at 9:31 a.m. on IPO day, bought at the open, and watched it fall 22% by noon. He didn't do anything wrong. He just didn't understand what market he was actually participating in. And that's the real cost of not knowing the structure. Not ignorance of tips, but ignorance of the game itself. So why do companies go public at all? It's not always the obvious reason people assume. Yes, raising capital is part of it. But early investors and founders want liquidity too. A venture capital firm that put $5 million into a startup in 2015 needs an exit at some point. An IPO is often that exit. The public market becomes the mechanism for early backers to cash out. That's not sinister, it's just the financial plumbing of how startup investment gets returned. But it does mean that when you buy an IPO, you're sometimes buying from people who've been waiting years to sell. They know more about the company than you do. That information gap is real and worth sitting with. Now, on the secondary market side, there's a different kind of misunderstanding that costs people quietly. Most people think trading volume and price movement reflects how well a company is actually doing. Often it doesn't. Price is driven by expectations, sentiment, and flows of institutional money. A profitable company with boring fundamentals can sit flat for 2 years while a money-losing one triples. That disconnect between price and business performance is one of the more disorienting things about secondary markets. It's not random, but the inputs driving price are layered, slow, and sometimes invisible to retail participants. Here's a number that reframes this. In 2023, roughly $400 billion was raised globally through IPOs and equity offerings. That same year, the daily trading volume on secondary markets was often above $400 billion per day. So the primary market, where companies actually get funded, is smaller than 1 day of secondary trading. The secondary market is mostly just investors rearranging ownership of the same assets at changing prices. Neither market is better or worse. They serve completely different functions and attract different kinds of risk. The primary market is where capital formation happens. The secondary market is where price discovery happens. Both are necessary. Without the secondary market, no one would buy in the primary. There'd be no exit. Without the primary market, there'd be nothing to trade in the secondary. They're not competitors, they're sequential. One feeds the other in a specific order. Marcus had held shares in a company for 3 years. The company grew revenue 40% annually. His shares were flat. He was furious at the market, but the market had already priced in that growth 2 years earlier. The mechanism bit him. The secondary market prices future expectations, not past performance. By the time good news is public, it's often already embedded in the price. This is why the structure matters more than the headline. Knowing which market you're in changes what signals you pay attention to. If you're evaluating an IPO, the relevant question isn't just, is this a good company? It's, who is selling? Why now? What's the lockup period? And what do institutions think the fair price is? If you're trading in the secondary market, the relevant question shifts to pricing, timing, and your own time horizon. These aren't the same questions. Treating them like they are is where most confusion starts. One practical thing you can do this week: look up the last stock you bought or considered buying. Find out when it IPO'd, what the original price was, and what it did in the first 90 days. That single exercise will show you more about market structure than most explainer articles ever will. The second thing, when you hear about an upcoming IPO, try to find who the underwriting banks are. That tells you which institutions are involved and which investors likely got early allocation. Public information, worth knowing. If this reframed how you think about what actually happens when you press buy, the next video goes deeper. We'll get into how price actually gets set in real time, and why 2 people buying the same stock pay different prices. Ask yourself honestly, did you know before today that your stock purchases rarely touch the company directly? Most people don't. And that gap between assumption and mechanism is where expensive mistakes quietly live. Primary market, company gets the money, once at IPO. Secondary market, everyone else trades that same ownership, forever, at prices the company no longer controls.